Good morning, friends. Good morning, all. Good morning, Vinayak sir.
Good morning. What about others? They are also live now.
Yeah, all are joining, sir.
Those who are in Zoom, they can ask questions.
Yes. They can ask, sir. Good morning, friends. So you can interact for 2-3 minutes. We will be going to start our session. So we are live also. So please, some interaction can do means. Yeah, some out areas they are asking, sir.
Yes, some confusion they are asking, mentioning.
Friends, before that, one request, all please mute the mic. Those who are asking question, the person only open the mic. Remaining all mute the mic.
When you are asking question, open your mic. When you complete your question, close your mic so that it will not disturb others. Okay, you are asking the first doubt, that is regarding bank reconciliation statement. When we talk about bank reconciliation statement, it is practically the account which you maintain at your home, at your house. And usually at the end of the month, the customer or even we tally our accounting, whatever you've done in your house, what we call it as a cash book, with the account which is maintained by the bank in the form of your savings bank account. Usually whatever transactions you pass or you post in your cash book at your, it is expected that the same will be seen as a mirror with your savings bank account in the bank. It is expected, but it won't happen like that because of the time frame. Usually at the end of the month, we require periodical statement, maybe monthly statement, quarterly statement. And when we are tallying our cash book, that is the account which you are maintaining in your house, with the account which is maintained by the bank, what we usually call it a passbook. Passbook is nothing but the copy of your savings bank account, which is given to you for your information. And usually what happens at the end of the month, there are some entries which you pass in your cash book. There are some entries which are passed by the bank directly. And since the communication is not reached, both will not update their transactions in time. And usually we give example, when on 29th April, when you are giving a check in clearing, usually what you do in your cash book, that is the account which you maintained in your house, you already post it as checks deposited in the bank, and you will add your balance. And you give that physically checks into the bank on 29th. And as all of you know, we are all having clearing systems. It will take 2 days, 3 days as clearing scheme or clearing time mentioned everywhere. Now, because of this clearing system, the checks which are deposited on clearing on 29th April are expected to be credited on 2nd May, 3rd May, or if Sunday is coming in between, again it will be delayed. So it will not be posted 30th April. And as on 30th April, we will be getting our passbook. You are trying to compare your passbook book which you are maintaining at your house, and there you will find some of the differences. Usually what we do, we tick all the entries which are common, that is which are implemented or which are incorporated in cash book and passbook. There will be some only 2-3 entries which are not posted in both the accounts. As I told you, checks deposited and clearing, that entry will not appear in the passbook because it was credited only after 1st May. Now, as a banker, we have to satisfy our customer that why this is not tallied. So instead of going on orally explaining him that why this is not telling, why this is not come, so the bank reconciliation statement format has been devised. It is a systematic format, and what we do is either you take your cash book as the balance, check the entries, and try to tell them that yes, because of these entries, our balance is not tallied. So what are those entries? Like first entry, I told you that the checks deposited in clear but not cleared before 30th April. Now your cash book balance is already added. So what we will have to do, if you want to tally your cash book with passbook, unless you don't remove those checks from your cash book, it will not tally with the passbook. In the same way, when the checks are issued by you, what you are doing, the customer is already deducting his balance from his cash book. Checks have been issued. So for him, money has already gone out. Whereas bank will not debit it unless the checks are presented or checks are encashed. So till that time, there is no posting in your savings bank account. Now, when you are tallying with the help of cash book balance, the checks which you have already treated as issued and deducted from your cash book, unless you don't add it back, it will not tally with the passbook because so far they have not been presented for encashment. Now, like this, there will be some entries which are posted directly by the bank, like your quarterly saving bank interest. If it is a loan account, your loan interest. So your periodical charges, that is ATM charges, checkbook charges, minimum balance not maintained charges, or whatever charges bank is levying, those charges will not be levied. Those charges are already debited to your savings bank account, but because you are not aware, these charges were not incorporated in your cash book. So when you get the information, what do? If it is a saving bank interest, you will add it to your cash book, stating that yes, passbook has done this, so I am also doing this, so that it will tally with the passbook. If ATM charges are deducted by the bank, you will also deduct your ATM charges from your cash book. So like this, whatever entries which are missing, which are not been incorporated, we will have to incorporate in the form of this statement. This is an official devised statement. So what we do, usually in your examination, they will give you that your cash book balance is this much. Now cash book balance is given to you and some 2-3 entries will be given to you, and they will say, what will you do with the cash book to tally it with the passbook? Then you will see the practical happenings. That is what has happened to this entry. And according to that, you will take action whether to add it in the cash book or you have to deduct it from your cash book. Now, this is very simple. And this, since it is your objective type examination, they cannot give you long statements. That means 5, 6 varieties of entries they will never give. They will only test you with your ability to whether you are able to understand the concept. So they may give only 2-3 entries and they will ask you to tick. So in the rough paper, you will have to do all these things, plus minus, and tick the correct answer according to you. And where the mistakes are expected, the same mistakes will be appearing in the choices. So by chance, if your answer is wrong, but the answer is appearing in the choices given to you, A, B, C, D, you may see, oh, I have also got this, it is there in the choice, so you may tick it. So don't go by that. Ensure that your concept is very clear. So, and usually IIBF because they will be testing your ability. They will be using different terms like cash book balance is this much. It is a very clear statement. This clear statement will not confuse you, but they will not make it in a so simple way. They may say cash book is having unfavorable balance of 5,000 rupees. Now the word unfavorable, it means it is a credit balance or it is a OD balance. These are the things which are very important when you are attempting bank reconciliation statements. The words they use it, unfavorable balance or credit balance or debit balance, or directly if they want to mention it, they may say directly OD balance. But they will not directly say that it is OD balance and start your working. Because then it is very easy, no? Arithmetical accuracy, you are all intelligent. You are all capable of doing arithmetical calculations. But here your testing will be only on the basis of your concept. Are you able to understand the concept? And if you are able to understand the concept, surely your answers will be 100% correct. So first point, which is very important, which you have to concentrate is which account is given to us, whether it is cash book is given to you to start the exercise or passbook balance is given to you to start the exercise. Very important area which you have to concentrate. Then the next point is whether it is a debit balance or credit balance. Now in cash book, when you say it is a debit balance, that means it is a deposit balance only. It is a favorable balance only. Whereas in savings bank account, when you are having credit balance, it is a favorable balance to us. In bank, you must have seen when you avail loan, when you are having debit balance, that means it is a OD balance. So only our concentration should be on how we are understanding the sentence which is given in the first phase. And after that, other things become very easy, because plus whether to you have to add it or whether you have to deduct it, it depends upon how much of practice you have done it. Are you able to visualize your cash book balance, cash book account? Are you able to visualize your passbook balance and then take action? I am sure there will be minimum confusion and you will be in a position to do it. But
Yeah, next, sir.
Yes, sir.
PPT and thing we can share, sir. Yes, sir.
PPT, okay.
So before that, friends, warm welcome once again to all to our YouTube platform as well as Zoom platform. So today we are discussing exam-oriented session by our senior most faculty and mentor, Sri Vinayak Apte sir. Sir is retired from us AGM from State Bank of India. So warm welcome, Vinayak sir. So we'll be starting the session. Before that, some small introduction sir was giving about the accounting part. So now sir is sharing the screen. Sir, few words from your side and then we'll start the session. Warm welcome once again. Yeah, Vinayak sir.
Should I continue?
Yeah, please sir, please sir.
Okay. Are you able to see the screen, friends? Are you able to see the screen?
Yes, sir. Yes, sir.
Okay. So, as I explained you see this format will be like this. Balance as per cash book is given to you.
Yeah, next screen half only, sir. Just you can. So
no, that because I don't want to make it full. It becomes very difficult to bring it back because we will have a.
Okay, sir. Okay, please.
No problem. I am making it larger.
Yeah. Okay, sir. Okay, sir.
Otherwise, time will be going only on.
Yes, sir. Please continue.
Showing it. So only as an example, I am showing it to you, because today our main issue is because in this 3.5 hours, that is 1.5 hour in the morning and 2 hours in the evening, we will have to concentrate on a lot of important topics, important areas, and therefore my focus is what are the basic principles which we should keep it in mind that we have to check. And then if any clarifications required, if any doubts are there, you can directly ask me so that we can shift to our next topic, which will be taken up for our discussion. Okay, friends. So our formats will be like this. So whenever we are going with the cash book, add checkbooks issued, because what has happened when the checks were issued, checks were debited. That means amount was reduced and those checks were not presented in the bank. And because of that, these checks are, the amount in the bank account is not reduced. So when you are doing it with the help of cash book balance, we have to make the necessary adjustments in the cash book only to ensure that your cash book balance and passbook balance will tally. So when the checks are issued, your balance is reduced. So you are adding back that balance in the same way. There are some entries which the bank has done it on its own, like dividends received, interest received, commission received, or any type of credit, or any customer has directly credited into your bank and you are not aware about it. All such transactions are already existed in the bank account, but because of lack of information, you have not received this information. So what you will do, you will check it from the passbook and you will make these adjustments in your cash book that yes, dividend received, which I have not taken, so I am adding it now. In the same way, checks were deposited by you and those checks were not cleared before 30th or before the last day of the month where you are tallying this passbook. So what you will do, because you have already added it in the cash book, you will deduct that much of amount so that your cash book and bank passbook will tally. Same way, all the bank charges which were debited by the bank, the customer is not aware. So when he looks at the passbook and understands, okay, ATM charges were debited or checkbook charges were debited or any standing instructions were there which were debited. So all those things you will also take into account and you will say less all these charges so that your cash book and the bank's passbook will be balance will be same. Now, this will happen when your account is deposit account. When it comes to OD accounts, OD accounts, what happens? In the case of cash book, it will be showing credit balance. In the cash book, it will show credit balance. Whereas in your passbook, in the bank, all your loan accounts will have debit balance. Please visualize this because all the transactions which you are going to deal, they will have impact on your understanding. If OD account, naturally all the transactions will have exactly reverse effect. Because when the checks are deposited, the OD account, your balance will come down. So when you are doing this reconciliation, what you will do, you will add back these deposits because of these the checks deposited in clearing, your balance, OD balance has come down. And bring it equal to your OD balance of bank, you will have to add it back. Basic things you will have to keep it in mind that whether you are dealing with a OD account or whether you are doing with a normal deposit account, because you cannot take it granted that if it is check deposit, do like this. No, it depends upon what type of balance is given to you. If deposit balance, your checks deposited will be deducted. If it is a OD account, your checks deposited in clearing will be added. So everything depends upon the balance which is given to you, which is very important for our transactions. In the same way, the when the passbook balance is given to you, the passbook balance is given to you, what really it impacts. Now, if it is a OD balance in passbook, now checks, if the checks are issued in a OD account, usually what happens? Can anybody tell when the checks are issued, what will happen to the OD account? Who will tell me? when the checks are debited in the OD account, what will happen to the balance of that account?
Balance will increase.
Balance will increase, exactly. And that balance has increased in cash book, but in passbook it has not increased because those checks were not presented. So when you are doing a reconciliation statement with OD balance in passbook, what you will write there? Add checks issued. So when they are added, your passbook balance will tally with your cash book balance. In the same way, when the checks are deposited in clearing, naturally your OD balance will come down. And when you are doing it with the help of passbook balance, what you will do, because the balance is already deducted in the cash book, but it was not deducted in the passbook. So you are doing it now, less checks deposited. So like this, visualize the account and see the situation, what has happened to this account and what is required to be done. Once you understand this basic principle, I am sure you will have minimum confusions. Go do it with a cool mind. Don't get excited. Don't get unnecessary tensed when you see a bank reconciliation statement. When you do it with cool mind, I am sure you can get correct answers because your visualization and you are understanding the balance and understanding the effect of the entry will be clear and correct. Okay, friends, this is all about basic things which you have to keep it in mind when you are going for writing or solving any issue on bank reconciliation statement. If you are having any specific doubt now, you can ask me.
Yes, friends, any doubt, please unmute and ask.
Please ask because time is short. Don't think that if I ask what will happen, nothing will happen. Even if it is a repeated thing, I will repeat it again for your benefit. But if you keep quiet, you are taking at your risk because your confusion will be same.
In the question given is that the balance as per passbook.
Yes.
Okay. And it is OD account.
Yes.
Overdraft account and at
it is
that time
bank account.
Overdraft bank account.
Yes.
At that time there is confusion to create the BRS, sir.
Now see, luckily for you, the slide which is shown now is the same. You are doing reconciliation of a the balance is given as passbook balance, OD balance is given to you. Now we will take this example only and go ahead so that you can understand it better. Now it is a OD balance means it is a loan account. Now checks are issued. When the checks are issued, your cash book is already entries are posted there and the checks are given to the customers. Now customer as per his convenience, he will come to bank and withdraw it. So as on 30th April, the checks which were issued by our customer, they are not presented to the bank. Now because of this, what has happened? The OD balance of cash book is more and OD balance of passbook is less because when the checks are issued, OD balance will increase. Now what you are doing? You are telling here, add checks issued but not presented. So with this, what will happen? Your OD balance of passbook and OD balance of cash book, both will tally because there also you already effected the checks and here you have mentioned it as add checkbooks issued but not presented. So the same amount will be added and your passbook balance and the cash book balance will tally. Now, in the same way, what happens when it is a OD account? Dividends received, interest received, commission received, or for that matter, any credit in the account directly into the bank, the bank OD account has been reduced to that extent because whenever there is a credit in the OD account, balance will be reduced. So, and those credit entries were not informed to the customer. So what has happened? Customer is not aware about these credits. So his balance is same, whereas in the bank passbook, the balance is reduced because already that commission, discount or dividend is already deducted. Now what we will have to do, unless you don't add it back, your entry of your passbook and the balance of the passbook and the balance of the cash book will not tally. So what you will do, add all these credits received, so that because they are not added, they are not affected in the cash book. So when you add it, what will happen? Your OD balance will increase. So your OD balance and the OD balance of the customer will tally. This is one effect. Second effect is, now checks were deposited in the clearing. When the checks were deposited in the clearing, already the customer has deducted that much of amount from his OD balance, which is maintained in his house. Whereas the checks were cleared only on 2nd May. That means on 30th April, these checks were not credited in your OD account. Now, because of this, what has happened? Your passbook balance is more, and the OD balance in the cash book is less because already their checks deposited in clearing were deducted from your OD account. So here what you are doing, less checks deposited but not cleared. So when you deduct it, your balance in the passbook and the cash book balance will tally, because they have already done it. You are doing it now for the benefit of this trying. And please keep this in mind. We are not making all these changes in your accounts. We are only preparing a reconciliation statement for the benefit of the customer and for the benefit of the bank. So we are only trying to tell them that because of these changes, your account and my account is not telling. So once customer looks at it, okay, this is the difference, no problem. Because usual tendency of the customers is, we are always right, bankers are always wrong. They will try to blame you. They will try to comment a lot of things on you. But when you give this such type of statements to them, then they will understand the mistake and they will say, okay, sir, no problem. So bank account and my account is tallied now. This is the main issue or main purpose of doing this bank reconciliation statement. So subsequently, these accounts are already implemented in the account. So in course of time, that will be tallied. But as on date, as on a particular date, because of these differences will make the difference of balances between the cash book and passbook. Okay. So friends, if it is OD account, what to do? If it is a deposit account, what to do? Because we are all bankers, we know in bank, if something is debited, what happens to a deposit account and what happens to a OD account. If you at least keep these things in mind, I am sure your understanding in the examination will be excellent. You will have a very comfortable solutions for all such type of questions which are asked. And sometimes they give only 2-3 entries. And usually they will confuse you with the wordings. Only they will play with your English, not with your knowledge of banking. So there only we have to be little cautious, because checks are not encashed. This is one way of telling. Other way of telling is checks are not presented. Meaning is same. But are we able to understand? If you are able to solve such problems in your practice, because for the last 17 days, we have seen that nearly 200 questions we have done it on the group. Nearly 250 questions we have solved in the Telegram. So those who have taken the efforts to understand this, I am sure their understanding will be perfect. Okay, friends. Anything on this bank reconciliation statement? Or shall we go to the next topic? And what should be the next topic? That also you suggest me, so that we'll concentrate on most important area. Okay. Yes, friends.
Balance sheet.
Ratios, sir.
Ratios. Very good. Okay, we'll go to the ratios.
Sir, small doubt, sir.
Yes.
BRS as for bank OD, who will pay, sir? It is customer or banker, sir?
What?
VRS as per bank statement.
Yes.
OD account. That is who will prepare, sir? VRS.
Now, usually what customers will do, they will take the passbook, they will have their own cash book with them, and they will tick the entries which are common and which are not common. From that common entries, they will prepare this bank reconciliation statement. Now, if customer is not aware about all these things, he may come with his cash book and your passbook and come to you and tell you, sir, this is not tallying, bank always does like this only, and they will start blaming us. So at that time, what you will do, because we are all perfect in these transactions. So what you will do, you will take either your balance or his balance, and the entries which are not ticked, you will start classifying them, which are to be added, which are to be deducted, and you will show him, sir, because of this, your balance was not tallied with my balance. Basically, customers will do it and show it to you that, sir, because of these problems, and they will not come also, they will understand. Yes, this is the reason, and it is a self-explanatory. But if they come to bank and if they ask you, we will have to show them, because this is a simple way of explanation. Because you cannot have a very complicated issue which they will understand. So what you will do, you will take this format, take the cash book balance, and treat the missing entries and show him the correct balance. So this can be done by the customer, this can be done by the banker also, for the convenience of the customer. Okay.
Okay, sir. On behalf of the customer, banker will do this, sir.
Banker,
Right, sir?
because now what happens, if he comes and shouts at you, no, you will be confused. Then you will ask him to cool down and you will prepare this and show him. Then it will be, his mind will be peaceful. Because he will understand the facts. As a banker, you know many things. But as a customer, no, they will only try to point out mistakes with the bankers. So in that situation, to calm them, to keep them silent, these things will help us. And this is actually reconciliation statement which is to your rescue. When you do it and show it to your customer, he will, I will do it at my house only. Because once he knows the trick, he will understand that and he will not come and trouble you again and again. This is a way where we always talk about customer satisfaction, customer delight, customer happiness. And these are the areas where customers will be confused. Because when money is less, he will get excited. And this is the best way to solve his issues systematically. You are showing them very systematically. You are not playing any magic. So they will understand it. Okay. Is it clear to you, my dear?
Yes, sir.
Right.
Thank you.
So we are going to the next important area, what we call it, ratio analysis. And earlier also, whenever I had taken this class in our regular, I told them that like we human beings, we are all interested to keep our body healthy. And how do you know that your body is healthy? So there are some parameters for the doctors. They will ask you to check your BP. They will ask you to check your what you will call blood sugar or your heart beating and all those things. And once they look at the report, they will say, okay, because they cannot enter into your heart and see how it is functioning. No. So what they will do, if your BP is 160 by 110, then he will say, sir, your BP is very high. You have to take care and all those things. That means these are the parameters which are giving indication of your health of your body. In the same way, we are dealing with our loan accounts. Whenever we are sanctioning loan accounts, how do we know the health of our accounts? And there, some time back, some years back, if you are 5 years old in the bank, we were having a system of giving health codes to our accounts. Those health codes were from health code 1 to health code 8. Now, after the implementation of this NPA management, now we are aware, they have classified the assets, and this classification is done on the basis of their health. If it is a standard, means excellent, that account is running excellently well. When it is showing some symptoms, like sneezing or coughing, that means it is showing some symptoms that it is going into a bad shape. How we are able to understand? With the help of these ratios. So these ratios are the indicators for us that how they are, you are able to, as a doctor, for all your loan accounts, you are a doctor for them. Because you are not only declining loan or sanctioning loan, but you are even guiding them. Sir, your liquidity is decreasing. You will have to take care. So these are the things, like your BP patient, your doctor says, no, don't eat salt. Go for exercise. Don't think more. Don't be in stress. Like that, we advise to our customers that your liquidity is reducing. It will affect your day-to-day transactions. So my advice is bring more capital. Then only your business will survive. So all these things are indicated to the customer with the help of these parameters. And when you talk about ratio analysis, first visualize. Visualize, I am using this word. I don't know how much of you are taking it very seriously. Visualize means when you close your eyes, just think about balance sheet. And the picture which you are able to see it on the screen, that picture should be visualized by you when you are closing your eyes. That is called as visualization. When you close your eyes and think about God, you imagine, no, that how God is, or how you are imagining your own idol. In the same way, you are visualizing the balance sheet, because this visualization will help you to understand who is where, because there are all these accounts are given to you. They will never classify it and give it to you. They will try to confuse you. So you will have to immediately reclassify them. When we talk about financial assessment or financial analysis of balance sheet, all your information given to you in your balance sheet will be classified in this way. Now, once you close your eyes and you think about what is a current asset, immediately that point must come to your mind. Yes, current asset means cash in hand, sundry debtors, inventory, that means stock or any bills receivable. Immediately we are able to tick to that point. And this is called as, this financial analysis of this balance sheet is done in this way. Now, if you see the long-term liabilities, in long-term liabilities are the liabilities which are going to be there in the business for a long time, more than 3 years. Capital and resource is the basic things. It will start with, the business will start with the capital and business will end with the capital. Is it not? So capital is therefore it is also called as permanent liability in the business. It will not go. Second is term loans. Whatever term loans we are sanctioning for purchasing of machinery, purchasing of building, purchasing of vehicles, these are all fixed assets. So whenever term loans are sanctioned, they are sanctioned between the span of 3 years to 7 years. Now this loan is going to be repaid in installments between these 3 to 7 years. If it is a housing loan, it will go up to 30 years also. So whenever you are talking about long term, there are some long term debts. Long term debts are our corporate customers like Tata, Birla, Ambani's, Bajaj, Mahindra's. They are very wise, they are very clever, they are having best CAs with them. So what they will be always doing, they will be always checking their profitability. To check the profitability, they will see if they take a loan, whether this loan is cheaper from a bank or I can do some. Please mute your mic. So they will check whether the loan is cheaper from the bank or they will have alternative source of income for them. Now, a company like Reliance or Tata's or Bajaj, their reputation is very good. So what they will do, if they come to bank for 100 crores loan, bank will say, we will charge you 12% interest. So 12% interest is going to be their expenditure, their expenses for them. Now they will check that if their reputation is good and if they come out with a bonds issue or a debenture issue, that means they will issue on their name some bonds to the general public, and they will tell them that these bonds will be paid back to you with 8% interest, or they will be given 9% interest, or whatever the rate of interest they are, or dividend interest they are declaring. So customers looking at their reputation, they may purchase these bonds. So in the process, what happens? If they take a bank loan, it is going to be 12% for them. But if they go for a bonds issue, it will be only 8 or 9%. So it is cheaper. So they may go for such alternative arrangements. But it is a debt. Today or tomorrow, they have to return back to their customers whatever bonds were issued. So it is also a long-term liability for a customer. So all such long-term liabilities are regrouped into the long-term liabilities, what we call it, in that particular group. Then comes the current liabilities. Current liabilities are the liabilities which are going to be payable within 12 months. Such questions are asked. 1 mark questions will be asked, that what is the time frame for long-term liabilities, or what is how you are going to classify as a liability into a long-term liability or a current liability. So a current liability is a liability which is going to be repaid within a span of 12 months. So what are the different items which are coming here? They are sundry creditors. They are the bills payables. That means whatever the we are purchasing on credit, we are accepting the bills which we will pay after 1 month or 2 months. Or all the bank loans, what we call it CCOD, cash credit and overdraft accounts. These accounts are sanctioned for a period of 12 months. After 12 months, we are expected to renew these accounts on the basis of their functioning. That means all these items which are grouped into current liabilities, they are all to be repaid within a span of 12 months. And there are some provisions like some expenditures we don't pay during this financial year, but we will have to pay it in the next financial year. Some reasons, some technical issues will be there. Because they are going to be repaid in the next financial year, all such things also will be considered under current liabilities only, because they are going to be paid anytime in the next financial year. So such overdue taxes, overdue expenses, or anything whatever is accounted in this financial year, but it is not paid to the customer or paid to the vendors, these things will be appearing as a liability. But they are going to be repaid in the next financial year. So they will be included as a part of current liability. So whenever the items are given to you or the accounts are given to you, first thing what we have to do is visualize where this account comes. In the same way, with the long-term liabilities, what we will do, we will purchase fixed assets, because these loans are going to be repaid after a long time. So the assets which are going to be useful to the company for a long time, they will also be purchased. So what they will do, they will invest that amount for purchasing land and buildings, plant and machinery, furnitures, vehicles, or whatever is going to be retained for more than 3, 4, 5 years. Then comes the current assets. Current assets are the assets which are converted into cash within a span of 12 months. That means which are realized. A stock, inventory, what we talk about. A stock, it is purchased. After purchasing, that company is not going to keep it with them for years together. They are purchasing that stock only to sell and earn profit. So that stock will be always moving. In the same way, sundry debtors, that means whom we are selling material on credit. They have to pay the amount after 1 month or 2 months or 3 months. So such accounts where the amount is due from the customers to the company, those accounts will be mentioned in the current assets, because they are going to create your cash in future. Then in the same way, bills receivable, all the bills which we have issued will be paid in as per their due dates. Then in your cash in hand and the bank balance, these are the most liquid things which we are having. So what happens is, All these current assets are the assets which are going to be realized within a span of 12 months. And what we are doing with the help of current liabilities, we are purchasing current assets. Now, current assets and current liabilities, if whatever current liabilities are there, you are purchasing current assets. If it is same, then there is no issue of any ratio analysis. But usually whenever you are sanctioning loan to a customer, what you are doing, you are telling him that whatever loan we are going to sanction you, it will be in the proportion of 75-25%. That means if you contribute your 25% margin, if you bring in 25% cash, we are ready to give you 75% loan. So for every 100 rupees current asset, that will be contributed 25% by the customer and 75% by the bank loan. Therefore, one thing must come to your mind, that current assets will be always more than the current liabilities, because current assets are inclusive of current liabilities plus margin of the customer, or alternatively it is called as net working capital of the customer, contribution of the customer, money brought in by the customer, liquid surplus available with the customer. They can use any terminology, but the result is customer's money is involved. To what extent it is involved, that will be seen with the help of ratio. Okay, so these current liabilities and current assets will be useful to us when we are going to deal with your current ratios. Now, the other areas are usually current assets. After that, there will be, for a banker, we will have one more column called as non-current assets. Non-current assets means assets which the customer is showing it as current asset, but as per a bank's terminology, we will not consider it as a current asset, because usually the items like investments are shown by the customer in the current assets only. But as a banker, when you are sanctioning loan to a customer, you will have to be very careful that for what purpose these investments have been made. If the investment has been made for creating a FD for obtaining a bank guarantee or letter of credit, that means for your business only, you are investing this amount in the form of FDs, because FDs will be treated as margin money for your bank guarantees. So when such investments are there, they are considered as productive investment, and such investments will be considered as current assets. But if somebody has invested money in shares, now shares investment is in no way useful to the customer's profitability in the company. It is not going to increase the profit of the company with the help of production or the sale of the products. It is totally a different investment. Sometimes the customers invest in their associate concerns, that means sister concerns. So whenever they are investing that amount into their sister concerns, it is no way related to the manufacturing process or the functioning of this particular company. So when such investments are there, those investments, a banker, what he will do, he will remove that from current assets and he will mention it in the non-current asset. Why it is necessary for a banker? Because you are going to sanction loan on the basis of the current assets. Now, if current assets are inflated with the help of these tricks by the customer, then you should be careful. You are not sanctioning a loan to the customer to purchase shares in the market. You are sanctioning a loan to a customer to run his industry, to run his business. So these things which we will have to keep it in mind. Whenever such things are asked in the examination, we must be in a position to clarify it. The other areas are what we call it intangible assets. Intangible assets are the assets which are only part of their reputation. We cannot see it, we cannot feel it, only the existence is there. Those assets are goodwill, copyrights, patents, And the new, where the confusion is more created in the minds of our participants, is preliminary expenses. It is not prepaid expenses, it is preliminary expenses and pre-operative expenses. These are the areas which will be more important for us when you are considering the items which are considered as intangible assets. A preliminary expenditure is the expenditure which is occurred or which has incurred by the company for inauguration or for installation, for introducing that company into the market. Because when you are introducing or doing some big show, when you are introducing that your company into the market, you will spend a lot of money towards your advertisement, publicity, or your inauguration expenses, like arranging lunch or dinners for the customers, or arranging a big show, spending money on celebrities, because celebrities don't come just for your satisfaction, they take money for that. So all such money which is invested by you, if it is taken in the same financial year, then it will be a huge loss to the company. So from income tax department and as per the law, what they have permitted us is you can bifurcate this expenditure for some years, and a portion of that can be taken it into the P&L account every year. For example, if you have spent 10 lakhs rupees on your inauguration function. Now, if you take the 10 lakhs in the P&L account of that year only, you may have a huge loss, because initial stages profitability is very low, and such loss will be carried over for 2-3 years. Then the reputation of your company will be spoiled. So what company will do? They will classify this as a intangible assets under the column preliminary expenses or pre-operative expenses. And what they will do? They will take only 2 lakhs every year and they will show it into the P&L account. Then where to show the remaining amount? The remaining amount will be shown as an intangible asset. Now this intangible asset will be written off or will be closed when the total money in this will be adjusted by this company in course of time, 3 years, 5 years, or whatever time is fixed. So till that time, this expenditure is only a accumulated expenditure mentioned in the balance sheet. So all these things, or if a company has incurred loss, when the company has incurred loss in a balance sheet, you will have to always show positive balances. You cannot show anything minus figures in the balance sheet. So usually what happens on the liability side, you will have capital and reserves. And the company will be having a reserves account separate. That is, whatever profit is generated, they will be mentioning it into that particular reserves account. Now, if there is a loss, we cannot show it as a minus figure in reserves. Then what to do? For that reason, they will show it as an intangible assets on the asset side. And whenever you start generating profit, this loss will be adjusted. Or if the company is closed, this loss will be adjusted. Therefore, whenever we talk about tangible net worth and net worth, this issue is created. I am explaining you with all the details so that any questions on this particular, a lot of questions are asked on this. 1 mark questions, half mark questions. We should be in a position to clarify each point whenever such things are asked. Net worth of a customer is the capital which has been contributed by him. But in course of time, he has created goodwill. So Ambani has created goodwill. So today his reputation in the market is very high. So although, suppose I will give you an example to explain this. Suppose Ambani has started a company with 100 crores. And in course of time, in 5-10 years, now you know the reputation of Ambani. You know, if you invest anything in with Ambani's, it is going to be gold. It is going to be multiplied. So the reputation of the Ambani is very good. So what Ambanis will do, they will tell that to the company that see, because of my name, my reputation is very high. If I want to sell this company, I can sell it with a lot of premium, that is lot of profit, I can sell it. Then how to show it in a financial term? Then he will say, sir, please add goodwill into my balance sheet. Suppose he says that my reputation is to the worth of 50 crores because he has already invested 100 crores in this company. And he says, if I want to sell this company, I can sell it to 150 crores also. Then they will say, okay, we will add goodwill into the balance sheet. But the rule of the balance sheet is balance sheet should always tally. Its liabilities and assets will be equal. Otherwise, in this process, what is happening? Your liabilities are having only 100 and your assets will have 150 because of 50 crores addition by the goodwill. So to tally this balance sheet, what we will do? We will add this 50 crores to the capital of this company so that liabilities also will be 150 crores and assets also will be 150 crores. On the asset side, only distinction is 100 crores will show it in the form of cash or bank balance and 50 crores will be shown as goodwill of the customer. Now this is very important. Why always we say that all the intangible assets must be deducted from the capital of the company? Why it is deducted? To understand the net value of the customer. Now, when we see in the balance sheet 150 crores, is it really an intrinsic value of the customer? No. Suppose tomorrow, if the company is closed, and if the Ambani says, my capital is 150 crores, give me back my capital. Now, company, how much cash company is having? Company is having only 100 crores cash. What was contributed by the customer? 50 crores was his reputation. Now company is closed. There is no reputation. So there is no question of considering that goodwill when you are making the payment. Then for that reason, what you will do? You will tell him, sir, your real value is not 150. Your real value is only 100, which is available with us, and we will give you 100 crores only. So 150 minus 50, again it will come back to 100 crores, and 100 crores cash or bank balance is available with the company. They will return it back to the customer. Now this, whatever we have arrived after deducting goodwill, that is called as tangible net worth. So net worth minus intangible assets is tangible net worth. And for all your ratios, even if they tell that capital and resource, net worth, equity, always for our ratios, you must take tangible net worth only. In your examination, they will give you some figures. Capital and resource 50 lakhs. And in the last sentence, they will say they are having 10 lakhs goodwill. And they will ask you to find out some ratio. So always be focused that whether any intangible asset is given in the form of goodwill, in the form of preliminary expenses, in the form of loss, then only this will be properly adjusted in your ratios. And if it is not taken, the choice also will be there, which you are committing a mistake of not taking that. And if you will see that, yes, okay, my answer is there, if you take it, also you will feel at that moment very happy, but the result will be negative. Because what was expected by you was, when you talk about any ratios, always your tangible net worth should be your base. So net worth minus intangible asset will be your tangible net worth. Now, in your course of our questions, which I used to give you on your group, on the first paper, I have asked you, one is simple questions. All these questions are some of the questions which were asked earlier in our examinations of JIB. So one simple question was asked, what are the tangible assets of the company? Very simple question, but you are carried away with the terminology of tangible net worth, and all those things. Here the question was, what is tangible asset? Now on your asset side, you will have assets total figure. The simple way was, from total assets, remove intangible assets. What is remained is a tangible asset. Very simple way. But because we are confused, we are more focused, then we don't get that idea. He is not asking about tangible net worth, he is asking about tangible asset. So the tangible assets are fixed assets, current assets, because they are having monetary value and they are existing. You can feel it, you can touch it, you can see it. Whereas goodwill, it is an intangible asset. So all these assets total, when you remove that intangible asset, what remained is a tangible asset. But after telling this, all our friends were surprised. Yes, this was so simple. But because we don't focus on that angle. So all these areas where your questions are expected to be asked, that area I am trying to focus it. Okay, so now on the basis of this, we go for current ratios. Now, when you talk about current ratio, arithmetically, it is current assets divided by current liabilities. Now, current assets, when I told you that you should visualize what we are visualizing, current assets means if you close your eyes, 4 or 5 things will come to your mind, that cash in hand, cash at bank, stock, sundry debtors, bills receivables. These are all the areas of your current assets. What are current liabilities? Current liabilities are your sundry creditors, which you have taken material on credit, or your bills which you have to pay after 1 month or 2 months, and all the working capital finance which is sanctioned to you. These are all to be repaid within 12 months. So why this current ratio is asked to you? This current ratio will indicate the liquidity position of your company, of your financial position of your company. Whether you are having sufficient money to run the business. Now, how to know your day-to-day transactions, whether the contribution which is contributed by the customer in the form of margin money, whether it is still available in the business. Because it is a practice of the most of the people is, slowly what they will do, they will try to withdraw their capital from the business and they will try to play only with the bank finance. So in the end, what happens? His money he has already withdrawn. Now only he is playing with the bank money. If the loan is NPA or if the loan is becoming default, he will tell banker, sir, whatever you want to do it, because only banker is having their own money in the business. To overcome such situations, we are more interested to know how much is customers' contribution into this business. Now, customers' contribution, how to know? Because as per our rule, it should be 25%. So, current liability is 75%. Customers' contribution 25% will be equal to current assets, whether it is happening or not. So by dividing your current assets by current liabilities, if you are getting a ratio of 1.33:1, it is considered as ideal ratio, acceptable ratio. Why I am using this word as ideal ratio or acceptable ratio is because earlier, some years back, Reserve Bank of India used to call it as a benchmark ratio. When the word benchmark ratio is told, it means you cannot sanction any loan if the ratio is less than 1.33. It was a demarcation. Banks were not allowed to sanction any loan if your current ratio is less than 1.33. But there are a lot of technical issues, administrative problems, financial problems, which a company has to deal with the customers. And please mute your mic. So bankers have their own ideas. They feel the customer is excellent. Please mute your mic. Should I stop? Friends, we are dealing with such an important topic and still somebody's mic is open. Their discussion is being heard. It is disturbing all of us. You're not mute. Barnai Devi, your mic is open. Please don't break this link.
Friends, please mute the mic.
This is an important area where a lot of questions are asked, where scoring questions are asked, 2 marks questions will be there. And if we are so casual, I don't know how we will be able to understand this. So friends, these bankers, they had their own view that RBI should not restrict our ratio like this. They should not make it a rule, strict rule. So when they have understood the bankers' issue also, their situation, now the Reserve Bank of India has given powers to the banks, individual banks, that you make your own board resolution and decide what should be your current ratio acceptable to your bank, on the basis of which you will sanction loan to your customers. And the bank will be wholly responsible to Reserve Bank of India if anything goes wrong. So bank, whenever they feel, now if I want to sanction a loan to Tata, Birla's, Ambani's or any other such reputed company, sometimes their liquidity may not be 1.33. But banker is sure because their collateral security is very good, their reputation is very good, standing is very good, and they are sure that company will not be duped. Then they may come out with the policy. In their loan policy, they may come out that yes, our bank is ready to sanction loan with the current ratio of 1.20 also for some selected customers. So to make this facility available to the bankers, Reserve Bank of India has changed its terminology from benchmark ratio to ideal ratio. And now we call it an ideal ratio. So when the ratio is 1.33, that means customer is having 25% contribution or his money is intact in the business. So only 75% of the loan is involved. So when customer's money is involved, bank money is involved, naturally company will run in a smooth way. Now what happens? If his 25% money is withdrawn by the customer, immediately it will start affecting the day-to-day business. He will not have money to purchase stock. He will not have money to pay his salaries to his staff. So all these things will start because the money has been reduced. So these are the symptoms which we get to know when we see this ratio. When this ratio is 1.5, I am comfortable. I feel that company will run smoothly because they are having their money, sufficient money to run the day-to-day business. Therefore, this is also called as liquidity ratio. And this liquidity ratio is important when you are sanctioning a cash credit loan or overdraft loan, CCOD loans. When you are sanctioning, this current ratio must be checked and it should be verified whether it is comfortable, and there will be no problem for this unit to run the business on day-to-day transactions. Now, are you able to be comfortable with this now? Do you have any questions? Please. Class is going on. I will speak after that. Yes, sir. Any question?
Sir, goodwill
No,
appears on which side of P&L account?
What?
Goodwill.
Goodwill will be there in the balance sheet, madam. It is a real account and it will be treated as an asset. So it will not come in P&L account. In P&L account, only the expenditure and the income items will be appearing in the P&L account. So all the assets and liabilities, they will be shown in the balance sheet. and it is a intangible asset. So it will be shown as the end. In the end, after fixed assets and current assets, you will find this goodwill in the asset side. Goodwill or preliminary expenses or loss or royalties, whatever these intangible assets are there, they will be appearing on the asset side of the balance sheet.
Okay, sir.
Right. So, friends, when this current ratio now, they will not just give you some items and they will ask you to do this because it is an objective type questionnaire. They will add some fixed asset item into your current assets and they will ask you to find out the current ratio. Or they will add some long-term liabilities into your current liabilities and they will ask you to find out the current ratio. Now it is your ability. Therefore, I am using that word visualize. Immediately, our mind should be alert. What are the items in current assets? What are the items in current liabilities? If anybody is trying to play mischief with this, immediately what you have to do? You have to remove that item from this set and then only find out the ratio. And this is your art. This is your testing which is happening in the examination. Because if straight away current assets are given, current liabilities are given, even the person who has got through 10th class, he will also do it because it is only arithmetics. But here, banking knowledge is more important, that what should be taken, what should not be taken. And that is the focus of IIBF when they are asking you these questions. Therefore, on ratio analysis, you will get lot of questions, theoretical questions, and lot of practical questions. Theoretical questions will be 1 mark or half mark, whatever they will just ask the principal. They will give you one asset and will tell you, they will ask you that what is this asset, in which category it will be classified. So you should be in a position to immediately tick to the right. If they say inventory, immediately you should understand that it is a current asset. If they say it is a patent, it should be immediately an intangible asset. Like this, that alertness will come only when you are doing more and more exercises. And for the last 15 days, we will doing these exercises. To some extent, you are updated. Your upkeep is excellent. So use that when you are writing this examination. Okay. So whenever a bank is sanctioning a working capital finance for a high value advance means maybe 500 crores, 1000 crores, like that. So for such accounts, we will have one more ratio called as quick ratio or acid test ratio. Now the purpose of quick ratio or acid test ratio is, for a banker, is in case company is closed today only, then what is the fate of a banker? Can we recover? Or we will have to wait, or our account will be pending. How to know this? Now, if you check the current assets, in current assets, except inventory, that is stock, all are immediately converted, can be converted into cash. Now, your cash in hand and bank balance, it is already liquid. Your sundry debtors, the people who are going to give you money, if you are in emergency, you can go to them and tell, sir, although you have to pay after 1 month, can you pay it today because this company is in doldrums? So you may say, okay, no problem, because that can be converted into cash immediately. But stock cannot be converted into cash because it has to be auctioned or it has to be sold. So banker cannot stand there and go on selling the products. No. So when this is the situation, now this is applicable only to the high value advances. For high value advances, because our stake is high, our loan is on a very higher side. So in that situation, banker is interested to know whether my loan can be immediately recovered. So it can be recovered only when the extent of stock is removed. Therefore, the formula which is used for arriving at the acid test ratio or quick ratio is current assets minus stock divided by current liabilities. So in this process, after deduction of stock, if your current, that is acid test ratio, is coming to 1:1, then the banker is safe. That whatever loan you have sanctioned, with excluding stock also, you are able to recover the loan from the company. So this acid test ratio or quick ratio, usually theoretical questions are asked more, that who will do this, why it is to be done, what should be removed when you are going for acid test ratio.
Please mute, friends.
So such questions you should be in a position to reply that current assets minus stock is the remaining liquid stock which is available. And if that is equal to the current liabilities, then your the ratio will be 1:1, and the company, the banker, will be more comfortable. So whenever a bank is going for a high value advances or heavy dose of loans, then we will go for this acid test ratio or quick ratio. Usually they will ask you what is the difference between current ratio and acid test ratio is. Current ratio, all the current assets are included. In acid test ratio, current assets minus stock is only taken into account for calculation of ratio. That means stock is not included. If you keep this important point in your mind, you will be in a position to answer any questions on this particular area. Okay. Now we will go to the next ratio, that is called as debt equity ratio. Debt and equity, these two terms we have to understand first. Debt is always means long-term debt. This is also called as solvency ratio. Long-term debts means what? All our term loans sanctioned or any bonds or debentures which are issued. That means any liability which is created, which is payable more than 3 years, all these are considered as long-term liability. So this long-term liability and the denominator is equity. Although it is written as equity, as I told you earlier, our calculation will be always equity means capital, but for our ratios, it should be always tangible net worth. Tangible net worth means net worth minus intangible assets. They will not give you like this straight away in the examination. They will give you some items and they will ask you to find out this ratio. So don't forget to deduct intangible assets if they are appearing in the question, and then only your ratio will be perfect. So long-term liability divided by your tangible net worth, it will give you an indication that how much money a customer has contributed for acquiring that long-term debt. And usually the ideal ratio is 2:1. That means if you want to purchase a machinery worth rupees 3 lakhs, maximum loan that can be sanctioned to you will be 2 lakhs, and customer will have to contribute his margin money to the extent of 1 lakh. That means you can understand that whenever you are sanctioning term loans, the margin money contributed by the customer will be higher than what he has contributed for his working capital finance. In this, for acquiring a term loan liability, you are going up to 33% margin. That is the most ideal situation for a banker and for a customer. That means 1/3 of the contribution should be from the customer and 2/3 will be sanctioned in the form of loan to the customer for purchasing that fixed asset. So whenever we are sanctioning a term loan to that particular company, you will have to find out this D ratio only to know whether the customer has contributed 33% when you are sanctioning a term loan to him. And this will give an indication in subsequent years also that your D ratio, that means your this debt equity ratio is stable. Therefore, this is also called as solvency ratio. So in this ratio, the purpose of this ratio is when you are sanctioning a term loan, whether this term loan is sanctioned with after seeing the comforts of that particular company, whether the customer is able to contribute 1/3 of his money and banker is only able to give him 2/3 of the money. If the ratio is increasing, that means the contribution by the customer is decreasing, and it is a very threatening situation for a banker. That means the customer is trying to take away his money and totally depending upon the banker. And when he is depending on the banker, he can raise his hands and run away, and banker will be in trouble. So to ensure that every time we will be going for this ratio, and to ensure that customer is also having his money into the business. This is called as solvency ratio, or it is called as D ratio. And this is only useful for long-term, when the long-term loans or long-term liability is created. Okay, any questions on this, friends? After that, we go to the next ratio, which is very important. We call it a gearing ratio. And this ratio is called as TOL TNW ratio. In our banking parlor, we usually use it as a TOL TNW ratio. TOL, total outside liabilities, and TNW, you are all aware, it is tangible net worth. Now what happens? Why this ratio has to be found out? This ratio has to be found out to know overall, when you deal with the total liabilities of this company, what is the contribution from the customer? So on the liabilities side, as I have explained you, first it will be capital and reserves, then it will be term loan liabilities like term loans or bonds or debts, then you will have current liabilities. So when you are talking about total outside liabilities, the important point should come to your mind is total liabilities of the asset liability side minus capital, minus your capital and reserves is your total outside liability. That means total liabilities minus customers' money, minus customers' net worth is his own money. So what is the proportion of his own money contributed to the total loans availed or total liabilities created by him in the form of long-term liabilities or in the form of current liabilities? And if this ratio is 3:1, that means if the liability side total is 4, then your capital and reserves can be 1 and all your liabilities can be 3. That means again, you will come to one conclusion that when you see the overall position liabilities of the company, customer must have at least 25% contribution. And when the ratio is 3:1, it means customer's 25% contribution is available in the business. If his contribution is increasing, if his ratio is increasing, that will give indication that his contribution is going on decreasing. Now if it becomes from 3:1, if it becomes 4:1. What do you mean by that? That means loans are extended to the 4 and his contribution is only 1. If you take it in the percentage wise, it will become 80% and 20%. That means customers' money has reduced from 25% to 20%. And for a banker, this is not an ideal situation. And in your examination also, they will ask you such questions that if the ratio is 5:1, what does it indicate? Immediately, we have to write that it indicates that customer's contribution is minimum and bank's liability or the liabilities are more, and it is a risk for everybody. If the ratio is, suppose, 2:1. If it is 2:1, that means it is less than the ideal ratio of 3:1. Here, what is happening? Here contribution is also 50% and liabilities are also 50%. So when his contribution are increasing, that means it is safer for him, it is safer for the bank, and it is safer for everybody. So the more the ratio, it is risk to the company. The less the ratio, it is a comfortable situation for the company, and it is comfortable situation even for a banker, because when more money is invested by the customer, the risk is less for the banker because less loan amount is sanctioned by you. So any such questions which are asked, theoretical or practical, we must be in a position to click. And for this, again, my word will be, please visualize. Visualize that what is really happening in the balance sheet. How much is money? How much is bank's money? And if bank's money is increasing, customer's money is decreasing, it is a risk for the bank. If his customer's money is increasing, then his ratio will come down and the ratio will be ideal. And we will always say that we can sanction this loan because this loan sanctioning will be comfortable to the bank. It will be repaid in time. So these are all the parameters which are given to the bankers, that before you sanction a loan, are you able to understand what is the health of this unit, whether their liquidity is good, whether the contribution of the customers, whether it is a term loan or a working capital, whether the contribution is ideal. If it is ideal, banker is safe. If it is not ideal, if it is going down, then it is a risk for the banker. And this is the area where your questions will be focused. Lot of theoretical questions will be asked, and scoring questions will be in the form of, they will give you some items in current liability or term liability, and they will ask you to find out the ratio, and the 4 options will be given. There will be wrong options will be there, but you have to choose the right option. So if you don't have any doubt, we will go to the next important ratio, which is called as Dscr ratio. This Dscr ratio is to be found out only when term loans are sanctioned to the customer. The Dscr is debt service coverage ratio. This debt service coverage ratio will give indication to the banker whether the repayment capacity of the customer is comfortable, whether the customer is in a position to pay his debts, pay his EMI regularly. Then how to know that? This can be indicated with the help of how much profit he is earning. Because out of his profit only, his loan installments are going to be repaid. So what is his extent of his profit? So when we are talking about his ability to pay, here we will have to be more focused, because his net profit, yes, that is his profit, which is as per the books. But what is the real capacity of the customer to pay? Surely it is more than the net profit. How it will be more than the net profit? Can anybody reply this question? How a capacity of the customer will be more than his net profit? Who can answer this question? I am telling that ability of the customer is more than this net profit. How? Anybody? Are you available?
Friends, please unmute and ask your doubt.
So, income tax provision.
Hello. My question
Hello,
was very
sir.
simple. My question was very simple, that I am telling you that the cash availability with the customer will be more than the net profit shown in the balance sheet or shown in the P&L account.
Depreciation, add depreciations.
Excellent, excellent. This depreciation is a book entry. We have not paid cash to anybody, but because of the depreciation, your profit has been reduced to that extent, but cash availability of the customer is not reduced. So what the term which we use is cash accrual. That is the cash available with the customer. So the formula to know the cash accrual of the customer is net profit plus depreciation. That means the real ability to pay the cash by the customer is more than the net profit. Several questions are asked on this point. And if we are not able to understand this basic point, I am sure you will not be in a position to reply such questions. So cash accrual is a situation where the customer's ability to pay will be more than his net profit because of the depreciation item. Because depreciation is a book entry, we have not parted cash to anybody, but because of the income tax benefit, we are showing it as an expenditure, and to that extent, we are getting exemption in our income tax. So to avail all these formalities, we are trying to take the advantage of this depreciation, but the capacity of the customer is surely higher. So the formula which is used here is cash accruals plus term loan interest. Why term loan interest is taken again in the numerator is because in P&L account, term loan interest is considered as a current liability because that is the money which is paid during that financial year. We have solved some questions on this topic also earlier, that term loan is for 10 lakhs and 50,000 is the money which is EMI for this financial year. So that 50,000 will become because the term loan installment or the term loan interest, which is considered as the current liability or which is considered as the item in the P&L account as an expenditure, has to be added it back because in the denominator, our denominator is EMI, equated monthly installments. This equated monthly installment means it is inclusive of principal and interest. Now, when we are taking it a denominator as principal and interest, and in the numerator, our net profit is after adjusting term loan interest. So to make it a common ground, a parallel ground, we have to add it back that term loan interest and then only find out this ratio. If this ratio is 1.75:1, that means if a company is earning 175 lakhs profit, your 1 lakh installment will be an ideal situation because 0.75 customer will have to run his family, to run his business, to run his activities. So we have to give that scope to customer. Whatever he is earning, I cannot take it as a installment for my bank. Then it will default. Your loan account will become NPA. So to arrive this Dscr ratio is arrived. This is 1.75:1. And if this ratio is 1.75:1, then banker feels comfortable that yes, this company will surely regularly will pay the installments in time. Now what happens? This ratio in the initial stage, it will be very less because profitability in the initial stage will be low. But the more and more years are added, your capacity to earn profit also increases. Your name is famous, so your production will be more, sales will be more, business will be more, and profit will be more. So in the initial stage, there is a chance that this Dscr ratio will be less, maybe 1.25 or 1.30 only. And if we go by the rule of RBI, then every loan will be rejected. But RBI has given you one concession or one route, that because whenever we are sanctioning a term loan for 5 years, we are taking balance sheet for next 5 years, what we call it projected balance sheet. And we are trying to understand what is his capacity every year to repay the loan. Now, as per this 5 years projected balance sheet, if in the initial stage, that is first year, if it is ratio is 1.25, next year it will be 1.5, third year it will be 2, fourth year it will be 3, fifth year it will be 2.5 or 3.5. That means the ratio is increasing because of the additional profit earned by the company. Now, if this is the situation, Reserve Bank of India has given you this tool that if you observe this, that company is incurring very good profits after second year or third year, then you are having facility to go for average DSCR. Average DSCR means if your average DSCR is coming 1.75:1, that is how you will calculate. You will add all the DSCRs for the 5 years and divide it by 5. And if your ratio is coming more than 1.75, then in that situation also, you will be in a position to sanction the loan. Although in the first year, the DSCR is less than 1.75. So the capacity of the unit to produce or sell, all these things will be made very important. And the repayment capacity of the customer will be assessed. And in the initial stage, bankers, what they will do, you will not have common installment for all the 5 years. First year, your installment will be less. Second year, slowly you will start increasing the installment. The more the profit, more the installment. So like that, you can accommodate your customer, help the customer, and try to allow the person to run the business and take a term loan from you. So as a banker, you should be always a friend to your customer. And DSCR tool is given to you. How this tool should be used for the benefit of the bank, for the benefit of the customer, it is up to us. And for this, questions will be huge. Lot of questions will be asked. That what do you mean by DSCR? Even the full form of DSCR is asked. Then what is the cash accruals? Why depreciation should be added? Then what do you mean by average DSCR? Or sometimes they use the word as gross DSCR and net DSCR. Gross DSCR is cash accruals plus interest on term loan divided by EMI. Whereas when we talk about net DSCR, the terminology what is used in that term loans will be principal amount will be paid in the installments and interest will be paid as and when due. When such condition is levied, that means whenever you are applying interest, that interest will be immediately paid by the customer. If that is the situation, you need not take interest into denominator or interest into numerator. So in that situation, your formula will be cash accruals divided by principal installment. Now they will ask you the difference between net DSCR, gross DSCR. Gross DSCR is cash accruals plus interest. Net DSCR is only cash accruals. These things we must understand so that it will be easy for you to write any type of answers whenever they are asked you in your, either it in the theoretical or in your scoring subject also. Then the last, this ratio we will discuss and we will close for the day. Return on equity, that is, every customer is interested to know that how much money I am earning by investing my capital into the business. If my return is not up to date, is not encouraging, then there is no point in running the business itself. So how to find out that ratio? That return on equity, what in short we call it ROE. It is profit before tax divided by net worth, that is your capital and reserves, into 100. This will give you the percentage of your return. If you are investing your capital and if your return is 10%, whether you are satisfied, whether you are happy, and year to year, this ratio will be compared by the banker. Last year, your ratio was 10%. Whether this is increasing in the coming years. So when the ratio is increasing, that means your return is increasing, your profitability is increasing. So customers or that person who is investing amount, he will be happy. Suppose his return on in his equity is 5%. Now, as a banker, I will suggest him, instead of doing business, better he should keep that amount in your bank. because you are going to give, even today, you are giving him 6% FDR interest. So you will earn more than the business which you are going to do. So this is a parameter for you to understand that how his money is invested and how the returns are being received by him, whether they are encouraging or whether they are alerting him. Then the another important area is return on investments. Return on investments means along with your net worth, that along with your capital, all the term loan liabilities will be added. That means all the term loan liabilities divide this profit before PBIT, we call it profit before interest and tax, divided by the term loan liabilities plus capital and reserves into 100, that will give you return on investment. That means your capital plus your term loan investment which you have made, whether it is generating sufficient profit. If it is generating sufficient profit, it is good for you. And there is no specific requirement on that. You have to judge every year. You have to judge as per the sector, as per the industry, and you have to come to the conclusion. And the customer has to decide whether his investment is profitable or not. As a banker, my interest is whether I am sanctioning a loan to a customer, whether his ROI and ROE is increasing every year. If it is increasing, it is good for the bank. If it is decreasing, it is dangerous for the bank. So for a banker also, to know whether to sanction him in a loan or not, it will be useful to you. And at the same time, it will be useful to you, useful to the customer also, to know whether his investments are safe and comfortable. So friends, this is all about ratio analysis. Any questions on this area, please ask. This is the last time for us before you are going to exam day after tomorrow. Anything which you are not able to understand, please ask me.
Yes, please unmute and ask.
Sir, bank lo general ga which ratio used, sir? In banks generally which ratio used for long term and general?
Very good question. In bank, if you are, this is an area which is questioned. This is useful only to the loans and advances. So whenever you are sanctioning a term loan, that banker, we will have to arrive at DE ratio. We will have to arrive at TOL, TNW ratio. Okay. If you are sanctioning him a cash credit loan, then you will have to go for current ratio and you will have to go for TOL, TNW ratio. Now, as per the bankers, now the Reserve Bank of India has made it so simple. They have devised the forms. In module D, we have discussed this. Form number 1 to form number 5. That is, all the information which is given by the customer is fed into these forms, and it is totally now computerized. And when you feed all the information from P&L and balance sheet, in the end, when you click the button submit, you will get all the ratios, whatever the ratios are there, as per the balance sheet, you will get the ratios. The role of the banker will be interpret those ratios as per our requirement, as per our norms. So if those if the current ratio as per that proposal, it is coming to 1.20. Now it is a decision to be taken by your bank whether to sanction your loan to that particular customer. Now it is your decision. So that interpretation has to be done by the banker. But only one thing as a banker, not only for this JIB examination, tomorrow after passing this JIB, CIB, you will be promoted. You will be holding the positions of field officers and managers. So always keep one thing in mind, that these forms are available with the CAs, these forms are available with the customers, and to mislead the bankers, they will give a rosy picture to the bank. The banker's role in module D, we have seen
that what are the important aspects a banker has to see before sanction of a loan. What we talk about pre-sanction. That means really the ability of the customer to do this business and the figures which you are given in the balance sheet, whether they match to each other. This is the most important area for our credit officer. Figures can be decorated because today if you go to CA and if you tell them, I want 50 lakhs loan, he will tell you that within 5 minutes, he will give you a balance sheet. He will prepare a balance sheet which is required for sanctioning and he will give it to you. But as a banker, what is important to me is whatever. Sir, please mute your mic if you are not asking question. Shahjahan. So Bharati, what is important is how we are viewing these ratios, because the parameters are before you. How to interpret these parameters with the practical situation of that company is very important. So these ratios will give you indication. And when you see the practical ability of that customer, now suppose they have mentioned in the balance, in the profit and loss account, that 500 lakhs is their turnover. And when you really discuss with the customer and see his project report and all other details and ability of that customer to produce that item, and if you come to know that this company cannot produce more than 200 lakhs, that means they are trying to fool a banker, travel more loan. So these things are very important when we are interpreting the balance sheets. So your main question was, how many ratios? All these ratios are important for a banker, but which loan you are going to sanction, which type of facility you are going to sanction, those particular ratios, you will have to deal with them. Okay. Any other question?
No, sir, ROE once again.
Yes, sir.
Return of equity.
Return of equity. Return on equity, ROE. See, I am contributing 10 lakhs capital. Now, always my interest should be how much I am earning every year on this capital. Okay, I am doing huge business. 5 lakhs are coming, 5 lakhs are going, 3 lakhs are coming, 3 lakhs are going. But at the end of the year, how much money your 10 lakhs capital has generated? So how to know? So whatever profit you have earned divided by your capital into 100 will give you the percentage of your return. Suppose you have earned 1 lakh profit. Now 1 lakh for 10 lakhs, you achieved a profit of 1 lakh. That means it is 10%. Now if you see 10%, 10% is more than the bank deposit returns, or for that matter, any other returns. 7-8% is usually when you invest, you will get it. But in the business, if you are getting 10% return on your capital, that means you are investing your capital in a better way. And you will try to continue the same investment in the coming years. Suppose your investment is 5%. You are earning only 50,000 profit on 10 lakhs investment. Then really you will feel unhappy. What is this? I am struggling from 7 o'clock in the morning to 9 o'clock in the night. And how much I am earning? Only 4,000 rupees per month. That is 50,000 rupees per year. Is it worth? Now that will give you indication whether to continue this business, whether to close this business, or what to do with this business, how to invest this money in a profitable way. That is the indication given to you for finding out ROE. That is return on equity. Okay. Is it clear?
Yes, sir. Yes.
Right. Anything else, friends? Time is already over, but I don't know it strictly because you are all, some of you are really doing excellent. You are solving the question answers. I am really happy. So surely More doubts will be with them because you have solved some of the problems. So if any of such doubts are there, please ask me.
Debtors turnover ratio.
Debtors turnover ratio. Good. Who are debtors, madam? Who are debtors? Simple words. Sundry debtors ante enti? Manaki ravalsindi. Very good. Because this question is asked by Ujjwala, I am taking liberty to reply her in Telugu because you have attended the class also. See, these sundry debtors are the people who have taken material on credit. Now, company, they will have to see how much material they are selling on credit every year. Now, enduku idi important? If everything you are selling on credit, మీ మనీ బ్లాక్ అయిపోతుంది, దాని తర్వాత మీ దగ్గర పైసలే ఉండవు and you will suffer. So in order to understand that how much debtors are there in your company and how it should be compared, it will be compared with your turnover, because out of that turnover only your credit sales are there. So if suppose your ratio is 40%, that means out of your total sales, your 40% sale is on credit. Now, how this is important? Suppose next year, this same ratio is increased to 60%. That means your debtors have increased. Other indication is that you may not be in a position to recover your debtors in time. So this ratio will give you indication that what is the proportion of your sundry debtors to your turnover. And as a banker, for a banker, why it is important? If your sundry debtors are increasing yearly and your turnover is not increasing to that level, surely I am in a little confusion that you are not making efforts to recover your sundry debtors. Those people are not paying you properly in time, or your product is not properly demanded. Your product's quality has gone down. Therefore, people are not paying to your products. So all these things will become important for you. So, manadi total turnover ki mana sundry debtors enta mandi unnaru amount wise, and that percentage ఇంత పర్సెంట్ ఉండాలి అంత పర్సెంట్ ఉండాలి అని అట్లా ఏమి ఉండదు. That is only a comparative study we will be doing. If this year it is 40, why it has increased to 50 or why it has increased to 60? Banker will ask questions to that company person. If they will get a satisfactory reply, I will accept it. If I don't get satisfactory reply, I will not allow him to take loan because his ability to recover money is not there. If he is not able to recover money, surely it is going to be a problem for the banker. In the same way, because you are asking debtors ratio, in the same way, even the creditors ratio is taken. How much total creditors are there in your company, and it will be compared, or that ratio is compared with the total purchases. Out of total purchases, what is the level of your sundry creditors? If that sundry creditors level is increasing or decreasing. So as a banker, it will be helping me because your sundry creditors and sundry debtors, they are going to contribute lot of information in your current ratio. So I told you, theoretical questions which are asked are like this only. If your debtors are increasing, how it is going to impact your current ratio? Like these questions will be asked. So this ratio will give you indication the level of your debtors to your total turnover. So increase or decrease will give you indication that what is the level of your recovery. In the same way, in the case of creditors. In the case of creditors, we will try to know whether you are able to pay your creditors in time. Like we recover your debtors, even we should have capacity to pay your creditors also. If you are not able to pay your creditors in time, that is an alarm given to you that your current ratio is not good. It is something is happening wrong. Your creditors are increasing. So we will ask a lot of questions. Like a doctor, you will ask questions on these ratios to your customer. Okay? Is it clear, Ujjwala?
Okay, sir. Okay, sir.
Right.
Thank you, sir.
సార్
Yes.
యాక్చువల్గా మనకి గోల్డెన్ రూల్స్ లో డెబిట్స్ క్రెడిట్స్ కొంచెం అవి ఎక్కువ కన్ఫ్యూజ్ చేస్తున్నాయి సార్.
ఎందుకు బాబు? See, golden rule based on your principle. Principle means what is the nature of account. Now, nature of accounts are classified into three: personal account, real account, and nominal account. First, your problem will be identifying the nature of account. If your nature of account is ideal, then your golden rule will be perfect. If your account you are identified as personal account, immediately you should know debit the receiver, credit the giver. If it is a real account, debit what comes in, credit what goes out. If it is a nominal account, debit all the expenses, credit all the gains or profits. Now here the main question is identify the account correctly. If your accounting identification is perfect, your formula is automatically, that is known to you. Our mistakes will happen only when you mistake the identification problem. Okay?
Okay, try.
Yes, Vinita, any question? Okay, friends. If no questions, somebody, I think somebody asked me on the chat, non-current assets. Non-current assets are the assets because in balance sheet what happens, you cannot throw some of the accounts from the assets. It has to be adjusted in your balance sheet. Only what we are doing is shifting from one category to other category. For our current ratio, we require current assets. And there are some assets which have been pushed into current assets by the customer, like investment in shares. He has shown is as investment in your current assets. Now, when you are bifurcating it, current assets, you will choose it. In that, you will write there, current assets lo nunchi, I am removing this investment in shares. Then where to put it? Because balance sheet lo ekkadana ravale. So it is coming into non-current assets, so that your current ratio will not be affected. If somebody has investment in sister concerns, that is not part of current assets. So as a banker, as a credit officer, it is your duty to first sort out the accounts which should be actually taken into particular category. And the same thing they will ask you in your examination, what you should take and what you should not take. So non-current assets are the assets which are payable maybe within a year, but they are not part of current assets because they are not contributing to the business. They are not contributing to the production or the business of that particular company. Investment in shares is not at all a productive investment for him. So such things should be removed. Okay. So friends, good day to all of you. Somebody asked me bills of exchange. Today evening we are going to meet. Please choose your important areas so that within the 2 hours we will be able to concentrate and solve your really critical issues. Because you must have seen for model B and model C, we have taken 20 days, nearly 30 hours. Now that has to be covered in 3 hours, 2 hours. So all your specific doubts which you are coming when you are solving the issues, please come out with that so that I can give you an instant answer which will help you for your getting 60 marks in your examination. Yes, Anuradha, in the evening, shares, depreciation, then bills of exchange. Surely, if you are there, when I ask you what is your question, please mention it so that I will know that you are available in the group. So friends, surely, in the evening at 7:30, be there and ask your first question, sir, what is depreciation? I will start. Because if I am explaining and if you are not there, then there is no point. Because there are 150 people in the group, I am not able to see that who is available and who is not available. So if you are available, show me by asking your question. Okay. So to all of you, prepare well. Now I have stopped giving you questions because you are all busy in your preparation. Okay, bye.
Thank you very much, Vinayak sir. We'll meet 7:30 evening.
7:30 sharp we will start.
All
so
please
that by
join.
9:30 we will be in a position to.
Sir.
Yeah,
Thank
good
you,
day
sir.
to all.
Thank you.
Thank you very much.
Thank you very much.